This video is about capital gains. It is linked to the chapter 35 of the textbook. I'm Carsten Berkau, full accounting professor in Osnabrück. My basics clips will help you to understand international bookkeeping. A company earns a capital gain if they sell a non-current asset above its cost of acquisition. This video is linked to the tax rates which apply in South Africa. Private persons have to consider 40% of a capital gain as taxable profit, whereas a company has to consider 80% of the capital gain as a taxable profit. We apply an income tax rate following the conventions of the textbook to the extent of 30%. I want to explain a capital gain for the company RUFFORTH Limited. The company earns three kinds of income. At first, there is income from operations. It records a revenue, which is 200,000. Material expenses are 40,000. Administration is 35,000. Second, the company earns a profit from renting out a building. The calculation is not called a revenue, as renting out is not the core business of the company, so we call it a gain, from which I have to deduct depreciation on the building. Now the third source of income is the disposal of a building. It is a building the company is renting out. The net selling price for the building is 1.4 million. The cost of acquisition of this building were 1 million. We further have to consider that the company depreciated the building, so the accumulated depreciation will be 40,000. Now we see that the company obviously rented out the building for 2 accounting periods. I want to calculate the gain on disposal. It will be 440,000. So the difference between the net selling price and the cost of acquisition is what we refer to as a capital gain. From the capital gain, which is here 400,000, only 80% will be taxable profit. This 80% is referred to as the inclusion rate. So the taxes gives me 96,000. The difference between the cost of acquisition and the accumulated depreciation is referred to as the recoupment. The total profit from comprehensive income is 468,500. There are special tax implications which requires that I also teach how to disclose other comprehensive income on the statement of profit or loss and other comprehensive income. To prepare the income statement, I already filled the header of the statement of profit or loss and other comprehensive income for the accounting period in 2002. The first step is I enter the figures for the profit from operations. There is revenue 200,000. Material expenses are 40,000. Labor does not apply. Depreciation is only relevant for the rental profit, so for that reason I first put in a 0. The other expenses are administrative expenses to the extent of 35,000. There is no interest, and we multiply the earnings before taxes with the income tax rate of 30%, which gives us 37,500. We will see later that there is a difference between the taxable profit and the accounting profit, but in this case this does not create deferred taxes. The reason is that these differences are not temporary. For that reason, deferred taxes do not apply either. The other comprehensive income is rental profit, capital gain and recoupment. I now have to calculate the profit after taxes based on the other comprehensive income. I start with the rental profit. Rental profit is 90,000 less depreciation 20,000, which I have to multiply with the tax shield. So the tax shield in accounting always means it is 1 or like 100% less 30% for the tax rate. That gives us the rental profit after taxes. The capital gain is always the net selling price less the cost of acquisition. As the company bought the property for 1.4 million and sold it for 1 million, it will be 400,000. Only 80% thereof will be taxable income. And I don't want to deduct the taxable income, I want to deduct the taxes, so I multiply that by 30%. Next I consider the recoupment. The recoupment is 40,000. The reason is here that we sell above the cost of acquisition. So for that reason, the total accumulated depreciation count as the recoupment. The recoupment after taxes is 40,000 multiplied by 1 less tax rate of 30%, and that will give me 28,000. I come up with 468,500. If you look at the income tax expenses, you notice that they will be only related to the operations. Now that you have seen the video, take the textbook and study the case.